The current geopolitical tensions in the Middle East are beginning to transmit into the global project finance market through energy prices, shipping costs, and credit conditions. Liquidity for infrastructure debt remains available, but lenders and investors are becoming more selective and increasingly focused on downside resilience. Energy markets are the primary transmission channel. Brent crude has recently traded above $100 per barrel and briefly approached $119, reflecting concerns around potential disruptions near the Strait of Hormuz. This corridor is critical because roughly 20% of global oil supply and around 1/5 of global LNG trade moves through the region. Higher volatility in energy markets is therefore feeding directly into infrastructure risk assessment and inflation expectations. The LNG sector is also seeing cost pressure. LNG carrier charter rates have increased from roughly $90,000 to more than $200,000 per day during recent disruptions. For lenders financing liquefaction plants, pipelines, and regasification terminals, this introduces additional uncertainty around transport availability, delivery schedules, and cash flow modeling. Shipping infrastructure is experiencing the most immediate cost escalation. War risk insurance premiums for vessels transiting the Gulf have increased from around 0.25% of vessel value to approximately 2 to 3% in some cases. For a $250 million tanker, that implies insurance costs rising from roughly $600,000 to more than $7 million per voyage, which directly affects logistics costs across energy and commodity supply chains. Renewable energy remains structurally strong. Middle East solar and wind capacity now exceeds 40 gigawatts, and governments continue to accelerate investment in energy diversification. However, renewable projects depend heavily on global supply chains, and disruptions to maritime logistics can increase EPC costs and construction risk. Lenders are responding by requiring stronger completion guarantees and larger contingency buffers. From a financing perspective, infrastructure debt pricing remains broadly stable. Operational contracted assets financed by banks typically price around 120 to 200 basis points, while private infrastructure credit and construction stage projects generally price between 200 and 400 basis points, depending on risk profile. The current geopolitical situation has not eliminated liquidity, but it is affecting pricing through secondary channels, including higher insurance and logistics costs, greater commodity price volatility, and slightly tighter credit committee risk tolerance. As a result, the market impact is typically seen through a modest increase in risk premiums, combined with slightly lower leverage and larger DSRA or contingency reserves in new financings. Overall, the project finance market remains functional, but underwriting is shifting towards stronger downside protection and more disciplined capital deployment in sectors exposed to geopolitical or logistics risk.